Look at the S&P 500. It's sitting near all-time highs. If you look at your brokerage account, you probably feel a sense of security. The mainstream narrative is that we've achieved a soft landing, but beneath the surface, a rare and ominous signal has just been triggered, one that has only appeared twice in modern financial history. In the early 1970s and again in 2008, we saw this exact setup. While stocks appeared strong, gold began to quietly outperform them. Today, even as the market hits record peaks, US stocks have actually lost more than 30% of their value when measured against gold. This isn't just a market fluctuation, it's a go signal for a systemic shift. We are going to dive deep into the data that Wall Street is ignoring. We'll look at the breakdown of the stocks to gold ratio, the reality of global debt, and why 2026 is becoming the focal point for what many are calling the Great Wealth Reset. If you have $1 invested in the system, you need to see this. We are all trapped in a nominal illusion. We see the Dow Jones or NASDAQ going up in dollars, and we think we are winning. But let's challenge that. Since 2021, the S&P 500 has nearly doubled. That looks like a massive rally, but when you step back and measure those same stocks against gold, the picture changes entirely. Stocks are risk assets, while gold is the ultimate safe haven. When the stocks to gold ratio is rising, it means the world is optimistic, but when it falls during a market high, it sends a mixed signal of divergence. This divergence suggests that the macro backdrop is shifting. History tells us that when gold starts outperforming stocks while optimism is still high, a deep recession follows. In the 1970s, inflation surged, and while stocks looked okay on paper, they lost 80% of their purchasing power. Today, we are seeing the same pattern. The currency you are using to measure your wealth is losing its value faster than your stocks are growing. It's a money illusion, and it's the first step toward a total wealth wipeout. Now, let's look at a chart that explains everything. US government debt overlaid with gold prices. The correlation is crystal clear. Gold isn't just reacting to inflation anymore, it's reacting to government finances. Right now, US national debt is over $34 trillion, roughly 1.2 times the size of the entire US economy. And this isn't just a US problem. From China to the UK and Japan, where debt is twice the size of their economy, the world is drowning in a sea of red ink. Why does this matter? Because when debt reaches these levels, there is only one historical outcome: currency debasement. Governments lean on central banks to print money to absorb that debt. We are already seeing the Federal Reserve resume purchases of treasuries. This money printing injects liquidity, which pushes stocks to all-time highs. But at the same time, it erodes the purchasing power of that money. Gold is rising because it cannot be printed. It's the only asset that doesn't have counterparty risk. As the world questions that this debt can ever be repaid, they are moving into the only asset that has survived 5,000 years of collapses. History is a series of cycles. We are currently in what many economists call the end of a long-term debt cycle. The rare warning signal we see today is a divergence. Usually, when inflation cools, gold prices stabilize. But today, even as the Fed claims inflation is moderating toward 2%, gold is surging to record highs. This tells us that the market is no longer afraid of prices. It's afraid of the system. If we look at the yield curve, it has been inverted for a record duration. Historically, the crash doesn't happen when the curve inverts. It happens when it uninverts. That process is happening right now as we head into 2026. This year is becoming a critical junction where the everything bubble meets the debt reality. The last time gold acted this way during a stock market peak, we saw 50% drawdown in equities. If you are not diversified into hard assets, you are essentially betting your entire future on the hope that this time is different. But in finance, this time is different are the four most expensive words ever spoken. So, where do we go from here? Wall Street wants you to stay all in because your capital is their liquidity. But the smart money, the central banks, and the 1% are accumulating physical assets at a record pace. You cannot stop the global debt collapse, but you can position yourself to be on the right side of the wealth transfer. First, reevaluate your real returns. Stop measuring your success in dollars. Start measuring it in gold or hard commodities. Second, diversify out of paper promises. Ensure a portion of your wealth is outside the centralized banking system. Third, watch the ratio. The stocks to gold ratio is your compass. As long as it's falling while stocks are high, the warning signal is active. The era of easy money is ending, and the era of real value has already begun. The signal is loud, the data is undeniable, and the warning is clear. But here is the most dangerous part. 99% of people will watch this, ignore the warnings, and become the exit liquidity for the elites when the 2026 reset hits. The financial system is designed to keep you distracted until it's too late. If you are not part of this community, the algorithm will likely bury these hard-hitting truths under a sea of noise, and you will be left standing in the dark when the markets go red. Consider this your last line of defense. If you value your family's financial survival, you cannot afford to miss the specific emergency exit strategies we are releasing next. Hit that subscribe button right now and turn on every notification. Either you prepare today, or you will be forced to watch the headlines tomorrow. Wishing you had listened. History is moving fast, don't let it leave you behind. Subscribe now, before the window of opportunity closes forever. Thank you for watching.